All right, so welcome back, everyone, for another deep dive. Remember when we talked about robbit.ai
Yeah.
and how its AI replicates the style of any fund manager you can think of?
Oh, yeah, that was pretty amazing stuff.
It was. Well, get this, there's this new tool that takes it to a whole other level.
Really.
It's called BullPig, and it's going to change how we all think about active fund management.
What's fascinating about BullPig is
Yeah.
that it doesn't just stop at replicating a strategy.
Right.
It uses that foundation, and then
Oh.
it starts to actively manage and even incorporate hedging strategy.
Hedging. Wow.
Which is something we haven't really seen before.
Okay, I'm already intrigued, so how about this?
What?
Let's use an example. Let's take SCHD,
Okay.
the Schwab U.S. Dividend Equity ETF, and we'll compare what robbit.ai does
Right.
versus what BullPig can do.
Sounds good.
And while we're at it, maybe we should mention why those traditional fund rating systems, like Morningstar, can sometimes fall short. You might remember the Hickory Hills Pension Fund.
Mhm.
They relied heavily on Morningstar's ratings,
Yeah.
and they ended up investing in Nuveen's Santa Barbara Dividend Growth Fund,
Right.
which didn't really live up to the expectations.
Exactly.
And there are tons of stories out there
Oh, I know.
about advisors basically letting Morningstar make decisions for them.
Yeah.
Remember the Hodges Small Cap Fund? Got a 5-star rating,
Mm-hmm.
and it was just flooded with investments.
Oh, yeah.
But then the performance, well, it tanked,
Oh.
and all the assets plummeted.
And even huge companies like Vanguard and Fidelity are paying tons of money
I-
to Morningstar for data and licensing.
Wow, it makes you wonder.
Well,
Are we all just obsessed with these ratings that only look at the past?
It's a valid point, because past performance doesn't always mean future success.
Right.
And just chasing those stars, it can sometimes lead you down the wrong path.
Exactly.
So let's see how robbit.ai and BullPig can maybe offer a different and more objective perspective.
All right, let's get into it. So this first screenshot shows robbit.ai's analysis of SCHD for the past 10 years.
Okay.
You see that red line that's tracking SCHD's performance?
Uh-huh.
That's robbit.ai's exchange-traded intelligent fund.
Wow.
It's also called an ETF.
Okay.
It's basically a whole portfolio of ETFs that are designed to mirror SCHD's strategy.
Interesting.
Pretty cool, right?
Yeah, it's impressive how closely it tracks the long-term performance.
Exactly. So SCHD had a return of, let me see, 209.58% over those 10 years.
Wow.
And robbit.ai's ETF came in right behind it at 203.16%.
Not bad, not bad. Okay, but now let's see what BullPig can do.
All right.
In this next image, we see BullPig's actively managed ETF for SCHD.
Mhm.
And here's where it gets really interesting.
Okay.
So BullPig uses 5-minute interval data over 6 months.
Wow.
We're talking about a very different time scale.
Right, because the significance of that shorter time frame
Yeah.
is that BullPig can take advantage of all those tiny movements in the market, all those ups and downs that long-term analysis might miss. All that makes sense, and look at the difference in return. So the BullPig ETF generated 13.28%,
That's great.
while SCHD only did 7.48%.
Not bad for just 6 months.
Exactly.
Yeah.
And there's another really key distinction here.
What's that?
Robbit.ai's ETF that's composed of other ETFs.
Yeah.
BullPig takes it even further, using individual stocks
Oh, wow.
and bond ETFs to make its actively managed ETF.
So it's like a team of expert stock pickers behind the scenes.
Yeah, but instead of intuition, they're using algorithms and real-time data.
Exactly. And that really allows for a more dynamic and responsive approach to portfolio management.
Okay, now this third image,
Yeah.
this shows BullPig's hedging model for SCHD.
Okay.
And this one honestly blew my mind.
Oh, is it?
So instead of just trying to beat the market,
Right.
BullPig uses something called covered calls with stock and bond ETFs.
What are covered calls?
So covered calls, well, they're a way to generate income by selling someone the right to buy stock you own at a specific price.
So if the stock price stays below that level, you keep the income and the stock.
Yes, but if it goes above, then you sell the stock at the agreed-upon price.
Ah, so you're basically putting a ceiling on potential gains,
Yeah,
but you're also cushioning your potential losses.
exactly.
And even though the market was pretty volatile,
Yeah.
BullPig's hedged ETFs still generated a stable 5.61% return.
Amazing. It's like this strategy brings the risk management that you only see with institutions.
Yeah.
And it brings it to the everyday investor.
Right. You could say that it's definitely a game changer in terms of accessibility.
So to recap, we have robbit.ai for long-term strategy replication.
Mm-hmm.
We have BullPig for the short-term active management. And then we even have this hedging model inside BullPig.
It sounds like an amazing combination.
It does. So what does this mean for the average investor? That's what we'll explore in the next part of our deep dive.
Sounds good.